To remain updated with the latest business news, click on the bell icon.
Hi folks, you're watching Smart Investor. I'm Sakshi Batra. Well, soon as the CPI and WPI numbers start to pour in, economists, bankers and policymakers all get calculating on the impact it will have on the growth of the economy and the way interest rates will need adjustments. Well, it's not just policy researchers who should be concerned about this price rise. All of us and our wallets get impacted every time this macro data increases or decreases. Here's how the money in your wallet, banks and investments get impacted when the inflation monster comes to haunt. Let us look at how the inflation impacts multiple asset classes. Inflation impacts fixed income investments the most due to its inverse relationship with interest rates. As inflation inches higher, investors also expect returns to move up to beat inflation. But interest rates on debt instruments or fixed instruments are fixed over the time and returns don't move higher. For example, when a bank savings account gives a return of 4% per annum, the real return is negative because of the last 12 months average inflation has been much higher than that. So over time, inflation can erode the value of those savings. It is because of this that most financial advisors suggest investing in assets which can have inflation-beating returns like equity. When it comes to equities, inflation can be good or bad depending on the level of inflation. A low to a moderate inflation at the level of 2 to 6% is generally healthy for equities, whereas hyperinflation of 10 to 14% is bad, as it ultimately impacts the company's margins. And investors must therefore look for fundamentally strong company stocks to invest in that can weather inflation and other economic storms with ease. Let us now come to commodities. Commodities are real, physical assets and are therefore a strong hedge against inflation. Commodities like basic resources, metals, energy, even agriculture produce tend to do very well under the rising inflation scenario and vice versa. Commodities tend to respond to changes in the dollar's relative strength in the international markets rather than the domestic inflationary pressures. Gold is also a precious commodity and is considered as the best inflation hedge, as it tends to protect the value of your portfolio in times of the rising inflation. Real estate is also another asset class. Property prices, rentals also tend to rise when inflation rises. For instance, whenever the inflation rises, commercial banks tend to raise the interest rates and property owners or landlords demand higher returns to offset these rising input and consumption costs. Thus, real estate is also a physical asset which has a high correlation with inflation. Inflation is therefore impossible to completely avoid, but by planning for it and by putting strong investment strategy in place, you might be able to help minimize the impact of inflation on your savings and on your long-term financial plans and investments. Therefore, if you wish to see such interesting and insightful videos which can be of use to your personal finance, do stay tuned on to Business Today. Like and subscribe to our YouTube channel and stay connected with us through all our social media handles, Twitter, Facebook, LinkedIn and Instagram. Thanks for tuning in.
If you like the video, do like, comment, share and subscribe.